Statement of financial position. By the end of this short presentation, you should be able to define and identify assets and liabilities and be able to construct a statement of financial position. Let's start with a little recap of what we've done in the past lesson. Okay, you should be able to answer these questions. What is a document called that shows a profit and loss that a business makes? What is meant by the term cost of sales? What is a formula to calculate gross profit? And what is a formula to calculate net profit? Take a few minutes to write down the answers, and I'll go through the answers with you now. I want to pause the video before I go through the answers. Okay, that's question 1. You should have an income statement, and it used to be called a profit and loss account because remember the income statement shows a profit or loss that the business makes. What's meant by the term cost of sales? Well, this is all the money it's spent when you're producing your product or your service. So the cost of producing your product or service. What is the formula to calculate gross profit? Well, revenue minus your cost of sales. Remember you need that formula for your exam. And the formula to calculate net profit, well, it could be revenue minus all costs, or it could be gross profit minus expenditure, so your other expenses. Okay, let's look into more detail. So which business is doing the best? If you see the two businesses there, you've got business 1 making a net profit of £100,000, or business 2 making £80,000. I'm going to assume that most of you think business 1 is doing the best, and is that the one you'd want to buy into if you saw that data? Probably. However, what should you be thinking when you see that data? Because profit isn't the only bit of information you need to know before you make an investment. For example, the net profit from business 1 may have come from selling off assets. So selling off its building and maybe leasing it back. So it actually made a large amount of money from actually selling off its building, and then it's going to lease it back and pay rent to the new owner. Of course, in the long term, is that a good idea? Probably not, because it's going to cost them money in rent. And if you think logically about this, they'll pay more back in rent in the long term because the owner of the building is going to want to make a profit. They're running a business as well. This is what Woolworths did with the high street store that you may have seen in the high street. It actually sold off its assets many years ago, and then when it ran out of cash, it had a problem because it couldn't make any more money. Of course, business 2 makes a net profit of £80,000. This came from the sale of products to customers. Now that's sustainable. That is a good profit because that's making revenue from selling off its products and services. And that's why it links in with the key words that we need to know for the exam. Business 1 made the most profit, but it made profit from a not sustainable source. Because think logically, you can't finance your business by selling off your assets. At some point you run out of them, and that's not sustainable. Just like at some point you would run out of putting your own money in. So if the business was investing money, he'd run out of his own money at some point, not sustainable. Also, you could argue that it's not sustainable to take out a loan because you can't keep borrowing money. At some point the bank would stop lending money to you, and you'd end up shutting your business up because you're running out of money. Whereas business 2 made lesser profit, but the profit it made was sustainable because it came from selling products or services. So because it did that, it can keep doing that all the time. That's a good form of profit. So you want the business to be able to make a sustainable profit, and only the document we're going to look at now can tell you that. Remember, the income statement shows a profit or loss for a business. It doesn't actually show you where that profit or loss came from, but our next document does. And that's why we're going to have what's called a statement of financial position. And this document, used to be called a balance sheet, shows you what any business is worth at any particular time. It's like a snapshot, a camera, taking a picture. So imagine a little click, 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 click. It tells you what the business is worth at any one time. Where our profit and loss account, or our income statement, shows you the profit or loss the business makes each year typically. What we get on our statement of financial position is we get the assets, so things the business owns, assets, and what it owes, liabilities. So what we could do is start by thinking about yourself. So how much are you actually worth? Make a list of all the assets you personally own, and try to assign a value to each of them so you can add them all up and get a total. Now bear in mind that if you have got your phone on a contract and you're still paying for the phone on a contract, that's not your asset. Whose asset will that be? The phone company's, because it still belongs to them until you pay it off. Anything that you've got that you personally own will be an asset, so you have to own it. Make a list of them. Maybe pause the video while you do that. Okay, now what we want to do is think about how much you actually owe. So the things you personally own. So what you want to do now, again, is try and make a list of all the items that you actually owe. money, or the people you owe money to. So it might be debt to mum and dad, for example. You won't have a credit card, but it might be your mobile phone bill each month you pay out, because obviously that's a liability, you're paying that out. Make a list of all the things that you owe. It should be a quick list, that should be. I'm going to pause video while you do that. And now, let's work out how much you're actually worth. So we're going to take away your liabilities and your assets. So assets minus your current liabilities will give you your total value. That's what you're worth. In my case, I'm worth £110. So I'm not really worth that much. You're probably worth way more than me. So who's worth the most money? There'll be some people with strange amounts of money that they're worth. Lots and lots of money if you consider their assets compared to their liabilities. What does that matter? Well, it matters an awful lot when you want to put a value on a company and what people are worth. So remember, assets are items a business owns, whereas liabilities are what the business owes. It's that key word, owns and owes. So assets are the things you own, liabilities are things you owe. So, what typical assets will a business have? Well, the most obvious asset people always say is stock. But there's an even more obvious asset that people forget, and the one I put there is cash. If you've got cash, that's the best asset you can have, money in the bank. People forget that all the time. You may have trade receivables. Now, they are people you've given credit to, so you might have given them 30 days to pay you, and they become what they used to be called a debtor. They have a debt to you, debtor. But they owe you money. They're going to pay you in the future, so they're a trade receivable. You're receiving money from them. So remember, trade receivables. They're a trade customer because you give them credit, and you receive money from them, so trade receivables. Machinery. That's an asset. Your building's an asset. You may want to value your brand name or your reputation or your loyalty. They're called intangible assets because you can't touch them. But they are assets. So Coca-Cola, for example, is an asset. Now, current assets is a term you will see used quite a lot, and you need to know this term. And all it is, that word current actually means the word current there, and you can see me circle it there. All it means is within 1 year. So we're talking about assets that we can turn into cash within 1 year. So which of the assets in this list here can we turn into cash within 1 year? Have a look at it, think about it. Which can we get into cash in 1 year? There's a really obvious one on there straight away. And there should be two more. Now I'm hoping you've come up with the answer. Stock, cash and trade receivables, because those three should all be able to turn into cash nice and quickly within a year. And we'll call them liquid assets because they can be turned into cash really easily. So now we also have this other term that's going in front there, which is called fixed assets or non-current assets. So you see these two terms being used, fixed or non-current. Now they are assets which take longer than a year. So remember, fixed assets take longer than a year to be turned into cash. Now, which ones on there would you think would be fixed? Well, hopefully you've worked out pretty quickly. The ones that take a bit longer to sell off. These would be the ones down here, your machinery, your buildings, and your brand name, your reputation, and your loyalty. They take longer than a year to turn into cash. So, when you've got your assets, your fixed and your current assets, you've worked out of it, let's have a look at the liabilities. So what liabilities does a business typically have? Well, typically you've got your trade payables, or they used to be called creditors. Now don't get confused with this. These are people, your suppliers, who you may have had credit from. Now notice the word there, trade payable. These are people that you've got to pay money to. You're paying them. So trade people who are dealing with you, your suppliers, and you've got to pay them. You owe them money perhaps within 30 days or 60 days. Remember, you want your payables to be longer than your receivables. You want to get the money in quicker from the people who owe you money before you have to pay it out to other people. Because it's in your bank account, it's sitting in your bathtub, as I always like to think about it. Your bank loan. So you might owe money to the bank. An overdraft. Now what's an overdraft? I'm hoping you're shouting out at me. A short-term loan. Remember, it's short-term, less than a year. That probably gives you a clue. The next question. So we have these things called current liabilities. Now remember the word current before. We talked about current being, if we see that word current, it means within a year. So these are liabilities. Liabilities, remember, things we owe, debts we've got. So debts we've got to pay within a year. So which of the ones below have we got to pay within a year? I'm hoping you're working this out nice and quickly. You should have worked out there should be two on there. You should have your trade payables, people we owe money to, we're going to pay them typically within a year, and our overdrafts we're going to pay within a year. And then we've got to look at the next, haven't we? Our long-term liabilities. Which are our long-term liabilities? Either people got to pay, it's going to take longer than a year. Which debts take longer than a year to pay back in total? Well, you've got your bank loan, that's going to be one. There could be another form of loan that I've mentioned in the lesson, a mortgage. You might have a mortgage in your building. That'll take you longer than a year to pay back. So these are long-term debts that are going to take you a long time to pay back. Probably planned as well. What does it all look like when it gets put into this document, this statement of financial position? It's not as scary as you may think if you follow the key terms. So you've got your fixed assets you start with. So remember, these are the things that you own that might take you longer than a year to turn them into cash for you to sell them off. So there's your building, your premises. You've got your machinery, which again will take you a while. And you total them all up, so you see there you've got your total fixed assets of £60,000. We've added the two numbers together. Underneath that, you'd have your current assets. Now your current assets are things like stock, remember, debtors, so people who owe you money, or remember what we said before, trade receivables, like I call them for what to, and cash in the bank. And those are your current assets. So that's all the money that you could get in from your business within 1 year if you were to sell it off really quickly. But there is a risk with stock. What's the risk of selling your stock quickly? Remember, if you sell your stock quickly, you may have to discount it, and that means it may not be worth what you expect it to be worth. And that's why some people don't include stock in their ratio analysis, but you're not doing that at this level at the moment. But if you're doing A level, you need to consider that a part of your ASCII test ratio. You've got your current liabilities. Now remember, current liabilities, again, these are things, debts you've got to pay within a year. So money you owe within a year. So your trade payables, people who you owe money to. Your creditors. So in this business, we owe £11,000 out to our suppliers. Our overdraft from the bank, we've got to pay that back. And then we total it up again to our total current liability. So we owe out £12,500 in the year that we're coming up to in this account here. A snapshot at the moment. Now you have this section, which some people get confused at, but it's quite simple. You've got your working capital. Now if you remember in the bathtub, when we did the cash flow, we looked at the money that was in the bathtub, and that was the money that was in the business at any one time. And that's actually your working capital that sits in the bathtub. Because your working capital is the money the business has got available at this moment in time. It's your current assets less your current liabilities. Remember, the money you can get your hands on within a year, take away the debts, what you're liable for within that year, so what you pay out. And obviously you want it to be a positive figure. Otherwise that means you can't trade because you actually are unable to pay your short-term debts off and you've got a problem. And underneath that you've got your net assets. Now your net assets shows what your business is worth in total. Your working capital plus your fixed assets. But remember, that's taking into account your long-term assets, the things that take a while to turn into cash. Beneath that, we have the capital column. The capital column shows where the money's come from, because capital is a fancy word for money. So you've got your share capital, and that's money you get from your shareholders when you sell shares. So in this case here, we've had £11,000 going into the business. So we sold shares, and we made £11,000. The advantage of doing that is it's free money that we get from the shareholder. We've also got retained profit. Now retained profit is a fancy word for money we keep in the business. So when we retain profit, that comes from a past year. For example, we may get £500 back from our past year. What you have to bear in mind here is that the shareholders are not always happy about this, because think about it, the shareholders want to get their hands on profit. So the shareholders are not particularly happy if you keep large amounts of retained profit. But they may be happy to keep small amounts because it stops the business borrowing from the bank. And remember, if you borrow from the bank, it charges you interest. And that actually costs you money. So businesses tend to look at it from both sides of the angles. Is it better to keep the money back and not borrow it from the bank? Or is it better to keep the shareholders happy and give them a dividend at the end of the year? You have to weigh these pros and cons up. But that's where the money's coming from in the business. Lastly, we have the long-term liabilities. So you got your bank loan, your mortgage, your long-term debts, and at the bottom you've got capital employed. And capital employed shows, it's a very fancy word, and all it means is the money that's being put into the business, employed in the business. So in total, £71,500 is employed in this business. And if you notice, that number actually matches with what we looked at before when we talked about your net assets, or what the company was worth in total. They've got to. It's a balance sheet. That's why it balances. That's quite complex. I accept that. So what I want to do is show you a simplified version, so you can see it on your screen in total. So you can now see a complete balance sheet or statement of financial position. You've got machinery as your fixed asset at the top there. So I've got my fixed assets, £10,000. Then I've got my current assets I put underneath it there. So I've got my stock, my trade receivables. Remember, people who I actually am owed money in from my debtors, so I've given them people credit. I've got cash in the bank. Notice I've totaled those up into that column, so I've got £8,000 in total. And then I've got my total assets. I've added up all my assets, and that makes sense. Hopefully my fixed assets plus my current assets gives me my total assets of £18,000. Then I have my liabilities. So I've got my current liabilities, debts I've got to pay within 1 year, my trade payables, so what I owe my suppliers, and my overdraft. And I've totaled those up and I've got £1,000 in total. So I've moved it across a column. Now remember my working capital, what we talked about before, what's in my bathtub, my working capital in the business, my current assets minus my current liabilities. So current assets, if you think up there, was £8,000. Take away my current liabilities of £1,000 means I have £7,000 in the bank. Then of course I'm going to do total assets less current liability. Less means take away. It's a fancy word for take away. So my total assets minus my current liabilities means that in total my business has got £17,000. That's the value of my company. And then of course I want to know where that money's come from. So I'm going to look underneath here. I'm going to look at my shareholders fund. So where's my money come from? Well, I invested £10,000 from share capital. So I bought £10,000 worth of shares in my business. I also kept back £7,000 from last year in profits. And that gave me a total of £17,000. And notice that those two figures balance. So my capital employed in the business is £17,000 and my business is worth £17,000. It balances. And it's as simple as that. That's how it works. What you probably want to do now is work that worksheet I've given you. So look at the worksheet you've done, go through the key terms, make sure you know them. Then practice by going through some of the workbooks we've got. And keep developing these skills. Make sure you're able to construct a statement of financial position and you know what the key terms mean and how it's used by a business organisation. Any questions, obviously feel free to ask. If you want to tweet me, feel free. It's at BeeBusinesBee. Follow my YouTube channel, watch this video, share it out with friends, or even attempt some of the quizzes that I've got on my website, because they're free and they're great to have a go at and try and develop your knowledge. Remember, you have to practice your knowledge to make sure you fully understand it. And it's going to be hard at first. It is not an easy topic.